First looking at strategic and then operational overview. Just want to give an update because it is a half-year result, so I just want to get some update on progress we've made so far during the course of this first 6 months. First of all, portfolio growth. We concluded 2 sizable transactions during this period. The first being Somerset Mall, that we took transfer of that mall on the 1st of October, and it's now part of our portfolio. And then in December, on the 5th of December, we acquired 87% of African land. And African land's only asset at this point in time is the Manda Hill Shopping Centre in Lusaka. Then in terms of developments, currently 2 major developments happening in our portfolio. The one is just next to us here, Rosebank Mall. That's due for completion in September of this year, and then the other one is the Westhill Shopping Centre in Accra, that through Atterbury Africa is due for completion in October this year. Looking at the rest of the portfolio and some other activities within the portfolio, as our continuous focus on refurbishment and expansions. We completed the extensions of the Edgar's stores at Canal Walk and the Glen. They now cater and provide quite a number of international brands within those stores. Canal Walk specifically has now got a Topshop in it. We redid the restrooms at Hyde Park, and the total spend there was 63 million rand for those projects. Then also looking at disposals, we disposed more of our non-core indirect holdings. We finally exited SICOM. I think we sold the last of the units in January this year. We also had a structure in place, Manta Blocks, that was still part of the original ad fund retail transaction. We had a 20% stake in that company, and that was sold in December as well. Then in terms of leasing, we saw that we were able to reduce our vacancies more in retail. We still got strong contractual escalations coming through in our portfolio. Total activity was about 60,000 square meters in leases, or 236 leases in number. We've introduced now a number of international brands into our malls. The Cotton On Group, who has been here for a while, it's from Australia. I think during this period we opened 3 more stores with them. And then other business with Edcon as well is their standalone stores from the UK. There we did 2 stores in Canal Walk, being at Lipsy and Dune. And then we also opened a Mont Blanc store in Hyde Park. And then great news for us is coming mid-year this year is opening of Forever 21. That's an affordable fashion brand from the US, very successful overseas, especially in the US and Europe. And they're going to open a first store in Canal Walk towards the middle of the year. Then looking at our investor base, we've redefined who exit their last shareholding. I think it was in October last year. That has improved the liquidity in the company. Now we sit with 97% free float. That has enabled us to now be part of many of the tracker funds and go on to indexes. One of them that I mentioned there, we possibly will go on the MSCI index. Then just briefly the financial highlights for the period. Lawrence will go in more detail in analysing the numbers. As Mike said in the introduction, distribution growth of 9.5%. I think that was above what the market expected us to do. Then some of the other highlights include our total expense to income ratio has remained stable. Total assets grew nicely by 11% to 25 billion. It's a combination of acquisitions, developments and revaluation increases. Our gearing went up to 26.6%, also due to developments and acquisitions. NAV grew by nearly 5% to 71.80 rand. And then our total arrears is also slightly up, but that also now includes Somerset Mall at 31 December. First of all, as mentioned earlier, there has been a reduction in our vacancies in retail, down to 1.2% as at 31 December. The significant reductions were at our value centres, and you can see there Willowbridge, Stonebridge improved significantly. The rest of our portfolio, our regional malls, the vacancies there are still mainly under the 1%. Offices increased slightly to 8.2%, then giving us an average of about 1.8%. You can also see there the largest vacancies at the moment in the portfolio is still the offices, then Cape Gate Lifestyle. Somerset, those vacancies was there when we took over the shopping mall, and that income was never in our budget. So we are working there on projects in order to reduce that vacancy. And then Stonebridge as well, where we've seen a significant reduction from the previous period. Then looking at our investment philosophy, we're going to increase, we plan to increase our investments into Africa to 3 billion rand over the next 5 years. We're really working with 2 investment vehicles at the moment. The one is Atterbury Africa, that's together with Attack and the Atterbury Group, that focuses on developing new shopping centres. There we've increased our commitment to 1 billion rand, for which we've got Reserve Bank approval. And then also with the acquisition of African land, we've got a team there now that will focus on buying existing high quality income producing shopping centres, and there are also a number of opportunities we're looking there. A bit more information on Manda for those who don't know it. It was the first regional shopping centre in Zambia. It's over 43,000 square meters in GLA. I think it's still one of the biggest shopping centres outside South Africa in Africa. Its market value is $149 million US dollars. The main tenants are Shoprite, Game, Home Corp, Woolworths, Foschini and Mr Price. And we can see from the trading stats that Shoprite and Game does exceptionally well at that centre. There is a good demand from retailers. The centre is fully let, but there are a number of leases coming up for renewal over the next 3 years. And again, that will provide us with an opportunity to look at the tenant mix, look at where we can make some improvements in terms of the tenant quality. And then just finally, looking at prospects and Hyprop's position. I think Hyprop is very well positioned with its high quality assets. Most of our centres can dominate its catchment areas. The average size of our malls are quite big. I think on average we're over 60,000 square meters per mall. It also enables us to attract new concept and flagship stores, especially amongst our national retailers. It's also a nice entry point for international brands who wants to come to South Africa, and at many of the malls they want to have their first stores in one of our major malls. We look at our good strong lease structure, good escalation. It does put us, the portfolio is very defensive in times when there's economic downturn. Hyprop as a company also has got a robust financial position. We've got a strong balance sheet with quality assets. With our gearing at 26%, we still got gearing capacity. We've got unutilized facilities, so that does enable us to act very quickly when we see acquisition opportunities coming our way. We also got an experienced management team. In South Africa, everything is internally managed. We've got a low staff turnover. Many of our staff has been with us for 5 to 10 years, and we do follow a very hands-on approach and get involved in our assets on a day-to-day basis. And then with Atterbury Africa and our joint venture partner there being Atterbury, we've got a very strong development partner as well. Then, as we mentioned in our results as well, we are improving our distribution growth from the forecast we gave at the beginning of our financial year, where we said 6.5% to 8.5%. We're now looking at, due to stronger income growth coming through, as well as some benefits on the African land acquisition, we're looking to improve that forecast to 8.5% to 10.5%.